They had two Nobel Prize winners. They had a formula that promised to eliminate risk, and they almost took down the entire global financial system. The dream. What if you could predict the future? Not with a crystal ball, but with math. What if you could build a machine so sophisticated, so brilliant, that it could print money, seemingly without end? In the mid-1990s, on the Golden Coast of Connecticut, a group of men believed they had done just that. This was an era of unbridled American optimism. The Cold War was won, the internet was booming, and it felt like history had reached its final rational conclusion. And in this world, a new kind of god emerged, the quant. The financial genius who believed the market, in all its chaos, was just a complex equation waiting to be solved. They were the titans of finance, the gods of the academic world. They called their hedge fund long-term capital management. And for a while, they seemed invincible. This is the story of how the smartest men in the room created a financial time bomb, and how, in the late summer of 1998, it came terrifyingly close to exploding. The architect. Our story begins with a Wall Street legend, a man named John Meriwether. In the 1980s, Meriwether was the undisputed king of the bond market at Salomon Brothers. He was a brilliant, laconic trader, a chess master in a world of checkers players, known for his quiet intensity and his preternatural ability to spot opportunities no one else could. He built a team of elite, PhD-wielding traders who were called the Arbitrage Group, and they generated hundreds of millions in profits. But his career was suddenly tarnished by a massive trading scandal involving a subordinate, Paul Moser, who had submitted false bids in a U.S. Treasury auction. Though Meriwether was never formally accused of wrongdoing, the stain was enough. Forced out of the firm he had helped build, he did what any self-respecting financial mastermind would do. He decided to build his own empire. But this wouldn't be just any hedge fund. Freed from the constraints of a large bank, Meriwether wanted to assemble the greatest collection of financial minds the world had ever seen. The gods of finance. He first went to the academic world and recruited the very architects of modern finance itself, two men who had just won the Nobel Prize in economics, Robert Merton and Myron Scholes. Their genius? They were the fathers of the Black-Scholes model, a revolutionary formula for pricing options. Before them, pricing an option, a contract to buy or sell an asset at a future date, was more art than science. Their model brought a level of mathematical precision to Wall Street that had never existed before. It was the bedrock upon which the modern world of derivatives trading was built. To have them on your team wasn't just an advantage, it was like having Einstein and Newton designing your car engine. Rounding out the team were other top academics and a cadre of the best young traders from Wall Street, poached from the most prestigious firms. They were the best and the brightest, the quants, the geniuses, and they had a secret weapon, the perfect formula. At its core, their strategy was beautifully simple. They called it convergence trading. Let's make it concrete. Imagine a 10-year Italian government bond and a 10-year German government bond. Germany is the economic powerhouse of Europe, so its bonds are considered ultra-safe. Italy is a bit riskier, so its bonds must pay a slightly higher interest rate to attract investors. Historically, the difference in yield, or the spread, between these two bonds is about 1%. But sometimes, for a fleeting moment, due to some random market noise or a minor political event in Italy, that spread might widen to 1.5%. The Italian bond becomes temporarily cheaper than it should be. LTCM's model would spot this microscopic divergence. It would then make a massive leveraged bet. They'd borrow billions to sell the expensive German bond and buy the cheap Italian bond, waiting for the historical 1% spread to inevitably return. It was a bet on rationality, on the reversion to the mean. And they didn't just do this with two bonds. They did it with thousands of pairs of assets all over the world. Japanese warrants, Danish mortgage bonds, Swedish stocks. It was a global scavenger hunt for microscopic mispricings. And it worked. Oh, did it work? In their first full year, 1995, they returned over 40% after fees. The next year, 43%. The year after that, 41%. They were making billions, not by taking wild gambles, but by making thousands of these tiny, risk-free bets. Wall Street was in awe. Banks begged to give them money. They leveraged their fund at an astonishing ratio. For every $1 of their own capital, they had borrowed $25, then $50, and eventually over $100. This leverage was their rocket fuel, but it was also dynamite. It meant that even a tiny 1% move against their bets could wipe out their entire capital. But they were the geniuses, the Nobel laureates. They had calculated the odds. They were a house of cards, but it was built by Nobel laureates, so no one seemed to care. The First Tremor. But every model has its assumptions, and every model has its blind spot. The Black Scholes model, for all its brilliance, assumes a world of calm, rational markets and predictable statistical distributions. It doesn't account for panic. The first tremor came in 1997, the Asian financial crisis. It began in Thailand, where the government was forced to unpeg its currency, the baht, from the US dollar. The contagion spread like wildfire, engulfing Indonesia, South Korea, and Malaysia. It was a political and economic shock that defied historical patterns. Suddenly, assets that were supposed to be uncorrelated were moving in lockstep, downward. Investors weren't differentiating between a solid company and a risky one. They were selling everything. LTCM survived, but their returns for the year were a meager 17%. The gods were showing their first signs of mortality. But they weren't worried. They saw it as a buying opportunity. They doubled down, convinced the world was being irrational and would soon return to normal. The Russian earthquake. Then came August, and in August came the earthquake. On August 17th, 1998, the Russian government did the unthinkable. It announced it was devaluing its currency and, more shockingly, that it would default on its domestic debt. The bomb went off. In the world of high finance, a default by a major country like Russia was supposed to be impossible. It was a 100-year flood, an event so rare it wasn't even worth putting into the models. And it triggered a global panic. Investors from Tokyo to London to New York ran for the exits. They didn't just sell risky assets. They sold everything. They fled to the one safe haven they could trust. U.S. Treasury bonds. And for LTCM, this was the perfect storm. Their model broke in every possible way at the same time. Their bet on Russian bonds was, of course, wiped out. But that was just the beginning. Their bets that European bond markets would converge, they blew apart as panicked investors sold everything but the safest German bonds, causing the spreads LTCM was betting on to widen, not narrow. Their bets on Scandinavian and Japanese markets, all collapsing. The one thing their models depended on, that different markets would behave independently, was the very thing that failed. In a crisis, all correlations go to one. Everything falls together. The domino effect, the losses were staggering. In August alone, LTCM lost 44% of its capital. They were bleeding $100 million, then $200 million, then $500 million per day. The dream team was watching their empire and the world's financial system disintegrate before their eyes. But here's the terrifying part. It wasn't just their money. Remember that leverage? For every dollar they had lost, they had taken down $100 borrowed from someone else. They owed money to nearly every major bank on Wall Street: Goldman Sachs, Merrill Lynch, Lehman Brothers, UBS, Chase. If LTCM went bankrupt, it wouldn't just be a hedge fund failure. It would be a chain reaction. The banks would have to absorb massive losses, forcing them to sell their own assets to meet their own obligations, which would crash the markets further, which would cause more losses, more selling, more failures. A domino cascade that could bring down the entire global financial system. The house of cards wasn't just their own. It was everyone's. The secret meeting. By mid-September, the situation was critical. The Fed, under the leadership of William McDonough, knew it had to act. This wasn't about saving a bunch of rich hedge fund managers. This was about preventing a second Great Depression. On the evening of September 23, 1998, McDonough convened a secret meeting on the 10th floor of the New York Fed. He gathered the heads of all the major Wall Street banks, the very same banks that were on the hook for LTCM's failure. They were rivals, competitors, who would normally be celebrating each other's demise. But in that room, they were forced to become partners. The message from the Fed was simple and stark. You have a choice. You can all pitch in to buy out and liquidate LTCM in an orderly fashion, or you can all go down together. It was a bailout. Not with taxpayer money, but with the bank's own money, orchestrated at gunpoint by the U.S. government. It took weeks of tense negotiation, but they finally agreed. 14 banks put up $3.6 billion to take over the smoldering wreckage of long-term capital management. The world had been pulled back from the brink, the ghost in the machine. So, what's the moral of this story? The partners of LTCM lost almost all their own money, but the shame didn't last forever. In a testament to Wall Street's short memory, Meriwether, within a few years, raised money for a new hedge fund. Merton and Scholes continued to be revered academics, sought after for their wisdom. The real lesson is one they learned the hard way, that no model is perfect, that the world is not a neat, predictable equation, that the most dangerous phrase in finance is, "This time it's different." The genius of LTCM was undeniable, but so was their hubris. They believed they had mastered the market, tamed the beast. But the market is not a beast to be tamed. It is a force of nature, capable of producing storms so rare, so violent, that they can break even the most brilliant of models. The ghost of LTCM haunted Wall Street for a decade, a cautionary tale of leverage and arrogance. But it was a lesson that, sadly, not everyone learned. 10 years later, the world would face an even bigger crisis. One built on the same dangerous ingredients: complex derivatives, now in the form of CDOs, massive leverage, now at investment banks instead of a hedge fund, and the unshakable belief that this time it truly was different.